Okay, well, welcome everyone to our Sunday evening call. We'll keep this to an hour, and let me just remind you how this works. If you do a super chat, then obviously you'll go to the top of the list and I'll answer your question straight away. We've already got several questions already, so thank you for those and welcome everyone. It was good to see that splashdown, which I was just watching, of the Dragon Demo 2 spacecraft worked. I was a bit worried about that. But anyway, so that all went well. Um, yeah, so obviously some changes. I've moved house. You can see the background's different from last time. And obviously I've had a haircut, another big change. And please do like the stream because it helps us. You will see links in the description below to the services that we offer. And obviously you can do a one-to-one with me, you can do a power hour, or you can join our community, and that way you get more interaction with us because you can ask a question on Slack, the chat application, and of course you can also join our live Sunday evening calls, which are a much smaller group of people, so it's much more likely that we'll answer your question. So do please support us. I'd really appreciate that, and do like the stream. Last time I complained a lot because people weren't liking the stream. Someone pointed out that if they're watching on TV, they can't like it. So I won't be so stroppy this time about people not liking. Anyway, so do please like us. We've already got 51 likes. I appreciate that. Thank you very much. So let's start off just by quickly going through what's been happening in markets recently, just to kind of focus our minds on what's been going on. We're about 2/3 of the way through the earnings season for Q2 2020. Remember, these earnings seasons are backward looking, and we're seeing a roughly 35-36% fall in corporate earnings in the United States, which is the worst corporate earnings since 2008, which was actually a bigger fall. I think it was about 65% in 2008. So it's certainly not looking good in terms of corporate earnings. But remember that was completely expected. We knew it would be bad in Q2. It'll probably be bad in Q3, maybe a bit worse. But then markets are expecting earnings to improve going into 2021. So really what's going to be key is the next earnings season, I think, to tell us whether we are going to get a V-shaped recovery. Initially, it's looking like that's unlikely because if you look at something like initial claims for unemployment benefits, which update on a weekly basis in the United States, that's been ticking up again. So it peaked at 6 million people per week at the peak, and then now it's going at about 1.4 million per week, and that's increased significantly over the last 2 weeks or so. So it looks like as lockdowns start to ripple across the United States again in fairly popular states like Texas and California, it's looking like activity is slowing down again, and it looks like people are being laid off. We're also seeing the end of some of the unemployment benefits, the $600 boost to unemployment benefits in the United States at the end of July. Now, if you look at the number of US citizens who are renting and who think they won't be able to meet their rent payment next month, that's roughly 1/3 of people in the United States. It's over 20 million Americans think that they are likely to miss out on their rent payments. So I think it's hard to underestimate what a tough time this is going to be for many people, even though the lockdowns are easing. So if that's the case, then it could be that we could be in for a fairly long-term slowdown in economic activity, and that's going to have an impact on growth as well. Plus, we're starting to see some of the effects on credit feed through. So we're starting to see default rates picking up, and people, once we leave this period when loans are being forgiven, then we will see people losing the houses where they live, and also having payments on their credit cards no longer forgiven. So, there are many consequences in terms of credit of the very sharp drop in revenue which we saw and the sharp drop in incomes, and also the effect of unemployment will feed through to credit issues over the next few quarters ahead. So, the credit impact is something to watch carefully. The unemployment numbers are something to watch carefully to see whether we're going to see a V-shaped recovery or not. So that's a quick précis of where we are. We've also seen a very strong, very rapid weakening of the US dollar after we saw those awful growth numbers this week. So we saw the US GDP fall on a quarterly basis, annualized, by around 35-36%, and in Europe it was over 40%, the fall in quarterly GDP. But that's an annualized number. But if you look back over the last 5 years, effectively what we've done is just wiped out 5 years of growth in the United States, and something comparable, I think, in Europe. So that's the kind of background. It's not great, I know, but there we are. So let's get started on the questions. Yeah, so do please like the channel and like the stream and subscribe to us, our channel, because obviously then you'll get access to our latest content. And I see we have 95 likes already. Thank you very much for that. And we have 200 viewers. That's great. So let's start on the questions. And let's start with Dams 66 Black. Oh, and thank you, Surya, for liking us. Surya says, what changes have you made in your portfolio recently? Well, now I hold 3 funds, as I did 4 months ago. I haven't really changed much. I haven't changed anything, in fact. I've just put more money into my account in the form of cash, which is my ISA allowance, my tax-free account allowance for 2020. And I've not changed anything. So I'm 80% in bonds, 20% in equity, so very cautious indeed. Of that split, the bonds are split 50-50 between the UK and the US. For the US component, I've sterling hedged it such that if the dollar weakens, I won't lose money. Now, if the dollar had strengthened versus sterling, that would have hurt me. It would have been a bad decision. But, I was lucky, right? I was lucky because I hedged. And now that the dollar is weakening, I'm not paying for that, right? But what would worry me is if inflation picked up in the US or if yields picked up in the US, neither of which I think is highly likely at the moment. So that's half of my fixed income allocation is US Treasuries. I'm lending money to the US government. And the other half is lending money to the UK government, but with long duration. Why did I go for long duration? Because I wanted something which was most strongly negatively correlated with equity. So if equity tanks, those long duration bonds will rally the most. And if you look at assets and how they've reacted since February the 19th, which is when equity was at its peak, the assets which have rallied the most have been fixed income instruments with long duration. So, for example, if you look at UK Vanguard funds, those are the ones which have given you the best returns since February. So I've gone for long duration UK government bonds and sterling hedged US Treasuries. And then on the equity side, which is 20% of my portfolio, I've gone for a very cautious minimum volatility fund, which is created by Vanguard. It's VMVL is the ticker. But all of that is in the video I just did. There's a whole playlist, which is how I invest my own money, which is part of the channel. If you go to our homepage for the channel, you'll see that on the list of playlists. So I haven't really changed anything over the last 4 months. I sold in February, I sold half my equity. I then sold my credit, investment grade credit, and I sold my EM bonds. And now I'm completely in very safe government bonds mostly, and then a little bit of equity, so 20% equity. Right, so Dam 66 Black, both Vanguard and Hargreaves have said that in the event of their company's failure, creditors could possibly have access to investors' funds. Please clarify or investigate. This is a question which we get a lot. both in one-to-one calls with me on Power Hours, where people say, look, is it safe for me to put, my whole pension with Hargreaves or with Interactive Investor or with Vanguard? And my response usually is yes, it is safe because of client money segregation rules, which is that they have to keep their money separate from yours. Now, in the event that, let's say, Hargreaves Lansdowne went bust, they do have access to your funds, but the question is how much of your funds and everyone else's they'd have to sell in order to pay off their creditors. Now, if they'd have to, I'd be amazed if it was more than some fraction of a percentage in order to do that. Because remember, these asset management companies and these investment platform companies, their biggest expense is people. They don't have huge manufacturing costs. They don't have machinery and plant expenses. It's just people. So it would be a one-off payment to pay those people off, I assume, and to pay their salaries until they were laid off. So that would be the biggest expense. If they own property, obviously they'd sell it, and that would go into the coffers when they liquidate the company. So I wouldn't be, in terms of the ranking of risks at the moment, the biggest risk probably at the moment is you, because if your behavior with your money is to panic or to take on too much risk, then, that's the biggest risk, and we have to control our own behavior, and that's the biggest risk. Second biggest risk is what happens to markets. So, market risk, obviously, if you're an investor, you're aware of that. How volatile are your investments? How well diversified are you? How concentrated are you in a particular asset class or a particular region or a sector? And then maybe things like currency risk would be a kind of tertiary concern. But, platform risk is well down the list in the UK because it's such a heavily regulated industry that I just don't panic too much about platform risk. So would I be worried about your comment, Damn 66 Black, which is absolutely true? No, I wouldn't, because I don't think that companies which are platforms would be undercapitalized in the first place. And secondly, I think if they did have to sell some of your assets, it would be a very small proportion of your assets. So I wouldn't worry too much about that. It is a risk, but it's not a huge risk. So NG Doc says, hi Ramin, would love to hear your thoughts about physical silver. It's had a run up recently. I noticed that actually, yeah, but seems to be positively correlated with stocks. Do you think we'll see a new bull market? So commodities like currency are very hard to call because it's very hard to value them. Obviously with silver, it's driven by industrial demand. And if we have a series, if we have a period of low growth, then industrial commodities tend to suffer as a result. So that's one aspect to it. Then you've also got the supply and demand. The supply of silver is usually driven, there aren't that many silver mines across the world. Chile's obviously very important to the silver trade. So industrial disputes obviously drive the price of silver as well. And then finally, the value of the dollar. So if the dollar weakens, commodities increase in value, trivially, because a weak dollar means strong gold. A weak dollar means strong oil. A weak dollar means strong silver. So that's the importance of the dollar. And a weakening dollar obviously has been good for all commodities recently. So, which of those look good for silver at the moment? Will the weakening dollar continue? I think probably, because US data will continue to be weak for some time. But if we do see a big equity sell-off, I think probably the dollar would strengthen as a result, because it is still seen as a safe haven. So it really depends on what happens with equity as well. And then if equity sells off, silver is a risky commodity. As you say, it's correlated with equity. That's usually the case. And if equity sells off, so would silver. Now, the reason why I'm cautious is I'm concerned that equities are hugely overpriced at the moment. So I don't like equity, and I don't like industrial commodities either. So personally, I'm just very cautious at the moment. Other people disagree with me. They think that we will see economic numbers start to improve very rapidly, maybe next year, and so markets are forward looking. So we should look through this period of volatility. So that's the opposite argument. And as usual, I don't push my view onto other people. I'd like to create an environment where people make up their own mind based on the education we provide. And I like to hear other people's opinion. I find that quite exhilarating. I think it's a good thing that we do have disagreement. And on PensionCraft, we do see disagreement quite a lot, but it's very politely expressed, I have to say. So, yeah, I'm slightly concerned about physical silver, whether the rally's sustainable. The dollar's a tailwind, and I think growth will be a headwind. And then supply and demand, very hard to call because it's driven by things like industrial disputes on the supply side. So yeah, that's my take on silver. I'm certainly not a commodities expert. I'm more of a cross-asset guy, but that's what I think. Arch123, hello, good day. Nice to speak to you. And Nesta says hello. Hi, Nesta. And John says, it looks like the FTSE could be rolling over, but no signs of US markets pulling back. What can you see being the catalyst for a reversal? US appears Teflon at the moment and impervious to bad news. Yeah, it certainly does look like that. Ooh, Fanta. What I would say is that the UK, the FTSE's been weak for a while now. The FTSE 250 in particular has been performing very badly relative to equity markets globally. I mean, I think part of that is Brexit, obviously, because there's still uncertainty about what's going to happen, and it's looking like the negotiations are going to be very tricky indeed, particularly with what's going on with the pandemic combined with that. So, yeah, I mean, I can kind of see why the UK is underperforming. In terms of the triggers which would cause an equity sell-off, those really haven't changed, I don't think. I think the credit consequences of the poor growth that we're seeing and also the sudden stop to revenue for many companies, I think those credit consequences will likely be a trigger, because typically when we get big credit events, then that's bad for the equity market. And if you look at things like the amount of money which banks are putting aside, what they call reserves for bad loans, they're putting aside a very significant amount of capital, both in the US and in Europe, which suggests to me that they're really getting ready for a credit storm. Now, it may be that never materializes, but you have to be aware that banks are preparing for that storm. And if there is a credit storm, then that would be bad for the equity market and obviously bad for the credit market. What does that mean in practice? Well, it means companies going bust. It means people losing their jobs. It means people defaulting on their mortgages and having their houses repossessed. So it's not a pretty story. It causes human suffering, and it causes a weakening of markets generally. So, yeah, I think credit is most likely to be the Achilles heel of this rally, but that's usually the case, right? Usually it's credit which kind of trips up an equity rally. But we just have to wait and see and monitor those credit indicators very carefully. Now that we are leaving these periods of loan forgiveness and also the payment protection boosts that we saw starting to end as well. So on the fiscal side, we are seeing governments becoming less generous, which is a worry. So all of those things like the furlough schemes ending, the boost to payrolls, the $600 payment, which people were getting in the United States but are now no longer receiving, which may be made into something much less generous, maybe $200 or less. So that obviously will have an impact on defaults, on growth, on earnings, and on consumer confidence. So I'd be concerned about all of those things. Those are the kind of triggers I'd be looking at. And that's the kind of thing which we discuss in our weekly market roundup, which is free and which you'll find a link to in the description below. Oh, that was so slick. Yeah, it's slick. A very slick sales job there. Did you notice? Very good. So, yes, please do like the stream. That would help us a lot. And Smith Raymond 9029 says he's watching from California. I was just watching California because Hawthorne in California in LA, which is where they were doing the control of the spacecraft for SpaceX was from. So happy Sunday afternoon to California. I had many happy Sunday afternoons in California. Wonderful place. Alan also, welcome from across the pond. Geordie, good evening. Jenny, hello. Oh, Geordie says, nice haircut. Yes, indeed. Such a relief not to have that scary hairstyle anymore. Believe me, as a kind of Middle Eastern looking man, having to wear a mask usually would get me shot. But hey, that's the beauty of lockdown, which is that I can wear a mask and people don't feel threatened, which is good. Nesta says hello. Right, so let's see if we can find some questions. Okay. Would US dollar, here we go. Would US dollar continue to go weaker? I have a bunch of cash parked as US dollars, and what would you recommend to keep its value? Buying gold or Treasury bonds? Okay, so what I would say, Owen, I mean, I don't make recommendations. If you want to preserve value, which is what you say, keep its value, then treasuries are a good store of value. Gold at the moment also a good store of value because real interest rates, which is the nominal rate of interest on government bonds minus the rate of inflation, or you could look at the yield on inflation-linked bonds. That's another way to get a read on real rates. Those real rates are very low or negative. And in that kind of environment, gold does very well. That's probably the biggest driver of gold, in fact, is real rates, the real interest rate. So, you know, gold, I think, is a good store of value. And if people are scared, obviously, they buy gold. So it's a safe haven asset as well. And in this environment, that's probably a good thing. Treasuries also. I mean, if you don't want to take a lot of duration risk, in other words, a long period of time that you're locking up your money, then you could go for short duration government bonds because they have much less volatility, they're much more cash-like, and they're much better at preserving your capital. But if, like me, you want to take a bit more duration risk, then that'll give you a bigger negative correlation to equity, so it'll be a better equity hedge. So it really depends on what you want to do with your portfolio. But you know, I think probably it's good to have that investment plan that we always talk about. So you know where you want to go with your investments, and particularly currencies are very hard to call. So if you don't have a view about US dollars, then don't take a view by having a hedged fund. What do I mean by a hedged fund? You'll notice in the title of some of these ETFs and also some of the open-ended investment companies or mutual funds that they say the word hedged, and they'll say which currency they're hedged into. So hedged sterling, hedged euro. That means that there's a derivative embedded inside the fund which removes all currency risk, or almost all currency risk. It's not all of it, but almost all of it, for a small extra fee. And it is a tiny extra fee with a currency swap. So if you don't want to take the currency risk, then hedge it. And usually you get that with bond funds, not with equity funds, but you can hedge if you don't have a view on currency. So yeah, I think would the dollar continue to go weaker? I think the kind of drivers of a weaker dollar, which is this bad economic data in the US, is likely to continue in the near term. But relative to the rest of the world at the moment, I think people are a little bit shocked by how bad it's got. So yeah, I wouldn't be surprised if the dollar continued to weaken. But as I say, if equity sells off, oddly enough, that would cause the dollar to strengthen usually because it is a safe haven currency. So next question. Michele says, oh my God, grocery bills explode. Yeah. And someone says you can like on your TV app. Well, that's good to know. So no excuses, in other words. Very good. Okay. Oh, there, we've done that one. Okay. Do you think earnings will get worse in Europe when government support programs to tide them over on weak demand due to COVID? Do you think earnings will get worse in Europe? Yeah, I think obviously when these programs of supporting US companies and also supporting people, because remember the biggest driver of corporate earnings in the US, it's a service driven economy, and it's a largely domestic economy. 75% of S&P earnings are driven by domestic consumers. It is a fairly insular market in that sense. So if people have less money in their pocket to spend because the government stopped handing out money, then obviously that's going to be a blow for US earnings. So yeah, I think that's going to be a problem when those government programs end. And also the furlough schemes, when they end, I think it's going to be a problem because it doesn't seem as if growth has picked up enough to fill the gap. It seems like the political will to bail out companies and people is fading before the economy has had a chance to recover, because it's lasting longer than people thought it would. Many people thought that by summertime things would be kind of okay as lockdowns ended, but that's really not looking like the case at the moment. So the longer this goes on, obviously the bigger the impact will be. Okay, so yes, so Alan says in the US evictions are going to start. Yeah. Will Smith, love your content, my friend. Appreciated. Thank you very much, Will. Steve says, I've always wondered why some funds, not ETFs, have spreads. For example, BlackRock's consensus range. Is this a hidden initial charge? Thanks, Steve. I guess it is in a way. The less liquid the fund that you buy, the bigger the spread between the buy price and the sell price. Is that a problem? If it's a huge spread, then yes, probably. But remember that most people should be buying these funds for and holding it for a long period of time. So let's say you buy a NASDAQ tracker today, right? So let's say you buy that NASDAQ tracker, you're going to hold it for the next 20 years. Over that 20-year period, it could appreciate in value by 200, 300%. If that's the case, then would you care about a 1% slippage on the day that you buy it? Probably not, right? So that's why I think, the slippage, really, if you're a day trader, you wouldn't be buying open-ended funds anyway, right? You'd be spread betting or something equally dodgy. So that's why I think the bid offer spread isn't such a big deal. But if it is egregiously large, I would worry slightly. But as I say, if you are going to be holding it for a long period of time, not necessarily a huge problem. But it is a hidden initial charge potentially. Yeah. Okay. Why invest in bonds with a negative real yield now when you could remain in cash at 1.5% plus until conditions improve? So firstly, you can get a yield of 1.5% in bonds if you go for longer duration in the UK, for example. I think the yield on long duration UK gilts at the moment is over 1.5%. So it's comparable with a cash account or the highest cash accounts you can get. And I think it's going to be a bit of a push to get 1.5% on a cash account now. I know that Marcus used to have very good cash rates, but they cut them. I think it's now less than 1.3, maybe it's 1.3. But anyway, the point about bonds is that they have a negative correlation with equity. That's the only benefit at the moment. They're not giving you a huge yield. more than cash. So the only benefit is that they are negatively correlated with equity. So if equity sells off, the bonds will rise, whereas the cash will just do nothing. So if you want something which will give you a leg up when equity falls, that's what bonds provide, with a negative correlation with equity. Equity crashes, bonds go up, and then when you rebalance, you can sell some of the thing which has gone up, which is the bonds, and buy equity. Whereas if you just had cash, it would just keep its value, right? It just does nothing. So that's why you'd invest in bonds. It's a negative correlation. It's a diversification that it offers. Also, you don't have to buy government bonds. You know, there are hundreds of different types of bond you could buy. You could buy convertible bonds, right, which are equity-like in some situations. You could buy corporate bonds, which give you credit risk. You could buy junk bonds. You could buy emerging market bonds. All of these give you a very good yield at the moment. So high yield, for example, at the moment would give you around 5% in terms of income. But obviously there you're taking a big credit risk. Or if you buy emerging market government bonds, there you're taking the credit risk of emerging market governments. So really, I think, saying that you shouldn't buy any bonds at the moment is just crazy, right? I think that's just not true. There's always some kind of bond which would make sense in some kind of environment. And so, if you think inflation's going to go up, you go for inflation-linked bonds, for example. So I think, I wouldn't dismiss bonds as part of a portfolio, because I still think they have that very important diversification angle in a portfolio, and also the capital preservation aspect, which is very important in this kind of environment. So that's why I still own a lot of bonds. Okay, and then Chris says, hey Ramin, given multiple markets, S&P, DAX, Nikkei, have seen somewhat of a recovery, what do you think the reason is for the FTSE seemingly lagging behind? Is this a trailing Brexit effect? I think one of the reasons is obviously Brexit. If we have poor earnings in the UK, then that's going to be an impact on UK equity. The thing is, the UK is a very open market, so a lot of the earnings are driven by foreign revenue. So a lot of the revenue comes from abroad, in other words. So for the FTSE 100, I think it's about 3/4 of the revenue comes from abroad. For the FTSE 250, it's about half, I think. And so, even if the UK tanks relative to the rest of the world, the impact will be biggest on the FTSE 250 and on particularly the FTSE small caps. So small companies in the UK, where almost all of the revenue, or all of the revenue, is coming from the UK. So I think that's one of the reasons. Another reason is that the UK, typically, the deal is we'll give you a big dividend. We're going to pay you back by giving you some of the corporate profits. Now, companies can just turn around and say, hey, we've had a bad time with our revenue. We're not going to pay you a dividend this year. And that's just tough. They're not going to default as a result. Whereas if you turn around on a bond and say, I won't pay, you become bankrupt, right? So you can't say I won't pay my bond payments, but you can say I won't pay my dividend payments. And that's exactly what we've seen. We've seen revenue falling for UK companies, obviously, because of what's going on with the pandemic. And then companies have been cutting their dividend. So in other words, the unique selling proposition of the UK, which is high dividends, has been eroded. Plus we've got Brexit, plus we've got the pandemic, which has hit the UK very hard. So I think that combination of factors has been particularly toxic. So the UK has been unlucky in that sense. So I think that probably is why. And also if you look at sterling, it's behaving like an emerging market currency. It's been very volatile. It's sold off massively when equity markets sold off. It wasn't seen as a safe haven at all, whereas it used to be. So I would be concerned about that too. And many international investors will just think, well, we've got this tiny market, which is 4% of global equity. it's got a very unstable currency. I just think there are better opportunities elsewhere. You know, I think that's probably why. Okay, I have a question. Oh, here we go. GBX hedged ETF or non-hedged ETF to buy. Is that a question? Maybe you're asking, do you know of sterling hedged ETFs? Yeah, if you want to look for that, just go to Just ETF. So Just ETF is a very good website. They list a whole bunch of ETFs and you can very easily check for a particular bond. So, I mean, why don't we do that? We can do that now. Let me just share my screen. And here we go. Just ETF. And this is what it looks like. And hopefully you can see that. Yep. Okay. And then we go to the ETF screener and we choose bonds. And then we choose down here, we choose hedged. So you choose sterling hedged, for example. So these are all bond funds, which are sterling hedged. Usually I sort by expense ratio because I like cheap funds, which are passive. So all of these are sterling hedged cheap funds. You can see the fund size here as well. Usually I go for something which is 20 million or more. So the first couple I'd maybe skip. Maybe I'd consider this one. Maybe the fourth one looks quite promising. So if you want 7 to 10 year US Treasuries, sterling hedged, that would be a good one. That's not a recommendation, by the way. So those are the kind of criteria which I'd use, and that's how I check. Okay, so that's how I'd do that. Okay, back to the live stream questions. And Alan says, why are there no Japanese bond ETFs or mutual funds? I think there are. So if we go back to Just ETF and I look for region, I look for country, and I look for Japan. Nope, I can't find any either. So I guess it's usually these things are driven by demand, right? So if there isn't a huge demand for it, then, and at the moment I doubt there's a huge demand for Japanese government bonds because the yield is so low. But I think there are. I mean, I certainly have seen Japanese government bond funds. I just couldn't find them just then, right? Sterling hedged. But they certainly exist. So it's just a matter of digging around. ETFDB in America is a very good website for searching for ETFs. Morningstar, another brilliant site for searching for ETFs or mutual funds. So all of these are free. Just go ahead and use them and search for things that you think you'd like to have. Okay. So yes, please do like our stream and our channel. I'd appreciate it. I see there are 384 people watching, only 200 likes. So even if you're on your TV, apparently you can still like our stream. So please do like it. It makes a big difference to us. In terms of the services we offer, let me just quickly recap. You can join our community, $10 a month, and then we have live Q&As like this, but kind of smaller. So it's more likely I'll answer your question. We have the chat application Slack, so that you can talk to me or other members of the community. You can ask each other questions. You can ask me questions. Although I have to say now, the combined wisdom of the community is probably better than my knowledge. But hey, that's the importance of the community. It's a kind of friendly place where we can ask each other questions, a kind of safe space where we all learn together. And if you want a one-to-one with me, you can always go to PensionCraft.com and there'll be a link in the description as well of this video on how to arrange a one-to-one power hour with me, if that's what you like to do. And we offer a whole bunch of courses as well, which you'll find on our website, PensionCraft.com. So, yeah, let's go back to the questions. There we go. So JJ says, I don't have any questions this week because my questions were answered in the Patreon Slack group. That's great to see. So JJ is a member of our community. That's good to see. Jambo Unchained says, what are your thoughts on the correlation between owning bonds and owning a personal mortgage? Both appear to be debt instruments affected by interest rates. That's a really good question. I think what's interesting about the UK is, or at least Europe and the UK, is that even though we have fixed mortgages, usually it's only fixed for a certain period of time. It's nothing like the US, where you can literally fix your mortgage for 30 years. We just don't have that yet. Maybe we will one day. So if interest rates go down, then, which they obviously have recently, I think it's likely that they'll stay down for some time because the central banks just can't increase rates without firstly bankrupting their own governments, but secondly massively affecting wealth, because a huge amount of wealth in developed countries is tied up in our property. And politically, it would be very unpopular to increase interest rates, and it would have a negative effect on consumption because of something called the wealth effect. So I think rates are likely to stay low for a very long period of time now, and so I'm not too worried about rates increasing. Now that's good for bonds and it's good for mortgages. So that's, even though we've seen growth suffer and we've seen unemployment rise, those are negatives for the equity market and for the housing market, but they're actually positives for the bond market, because remember, the bond market thrives on bad news. Equity rallies on good news, bond markets rally on bad news. So that's why diversification is good. In terms of whether you should buy bonds or pay off your mortgage, that's very much driven by, I think, much more by psychology, because many people would rather have the security of owning more of their house than they would get capital gain in the bond market or the equity market, because of the psychological security of thinking, this bricks and mortar is mine. Nobody can take it away from me. And if that's important to your psychological well-being, then yeah, it makes absolute sense, even though it may not make rational sense in an economic sense, because you may well be able to get better returns on, say, equity and bonds than you would for property over the long term. So that's why, for many people, it's much more of an emotive issue than a purely economic one. So it really depends on your quality of life, right? If you're going to feel bad that you've got a massive mortgage hanging over your head, and you might lose your job tomorrow and then lose your house and your family would be out on the street, then yeah, pay off your mortgage if that makes you feel more secure. Because yeah, it is a risk. It is a risk. So yeah, I'd really say that the mortgage versus investment argument is one that's very personal. But certainly that's the kind of considerations which I'd have. A rate's going to go up, and I think that's unlikely in the near future. Bonds versus cash in the current environment. We've kind of covered that already. Yeah, cash versus bonds. The only difference at the moment is correlation. So you just get better diversification with bonds than you do for cash. Delatroy, is there a cost-effective way for individuals to have a bank account decontaminated in gold so that our savings won't get eroded due to inflation and negative interest rates? Well, firstly, gold is a really awful inflation hedge unless you get things like hyperinflation. Just plot the value of inflation versus the price of gold and look at the relationship between the two. There's a very weak link between them. So what's much more important for the price of gold is real rates, real interest rates. Because if you have very high interest rates for government bonds, you just don't buy gold because it gives you an income and it's safer. Whereas if interest rates are very low, like they are now, the comparative advantage of bonds just disappears. So that's why gold is more valuable. So in terms of worrying about inflation, if you are worried about inflation, the only instrument which protects you is inflation-linked bonds. And it's the only instrument where you don't diversify. You go for inflation-linked bonds in your own currency, because inflation in the UK, in the US, are different. And it's your quality of life, it's your consumption currency which matters. So if you live in the UK, you buy UK inflation-linked bonds. If you live in Europe, you buy European inflation-linked bonds, and so on. So that's the only way to protect your money from inflation. In the case of deflation, obviously cash suddenly becomes very attractive. So that's the hedge against deflation. So very different depending on what happens. And I've done a whole video about inflation versus deflation, where I talk about all of this in a lot of detail. So just Google that, PensionCraft, inflation versus deflation, and you'll get the video. Right. If inflation picks up moderately, what do you think is the best asset to complement stocks with? Well, I mean, a moderate inflation actually isn't too bad for equity. So equity can shrug off fairly small inflation. It's when it gets to around 3-4% annual growth of inflation, that's when equity starts to derate, because it gets to the point where companies can't pass on their increased cost of sales to their customers. So that typically has been a negative for equity historically over a very long period of time. So yeah, I think, equity is a reasonable, if it's moderate inflation, equity is a fairly good hedge. But if it gets beyond that, like 4%, 5% inflation, then yeah, really you should be thinking about inflation-linked bonds. Right, I got 1k in Wisdom Tree Metals. Should I get more? I really can't say. That depends on a whole bunch of things, which I don't know about you. So I couldn't really comment on that. What has to happen so that you buy more equity? Well, for me, valuation is very important. So that's why every week, pretty much, I look at FactSet's report by John Butters at FactSet. He publishes at about 8 p.m. US time on a Friday. And this tells you about the latest earnings report. And I monitor that very carefully. And currently, the S&P, on almost any valuation measure, is incredibly expensive. So for me, valuations would have to be far below where they are today in order for me to buy equity. So if there's a huge equity sell-off, or even a quite big equity sell-off, that's when I'd consider buying equity. But certainly at the moment, I don't think that's going to happen. Or even if there was a prospect of earnings increasing significantly, some kind of catalyst for that, a development of a new technology that would transform many, many different industries, that would obviously be a catalyst, or a cure for the virus, something like a vaccine that was effective and widely available, any of these things which would substantively improve earnings, then yeah, that would make me consider buying more equity. But at the moment, I just don't see those catalysts in the near future, which is why I'm still very cautious. Do you have advice for a UK investor that will meet the 20k ISA limit and is not interested in waiting for 65 or so with a SIP, but want to invest on a regular basis? Okay. So it sounds like you've hit your 20k ISA limit, and you don't want to put the money in a SIP. No. In short, it's very difficult to, there is no other way to invest in a tax effective way. So you'll just have to fill out a self-assessment form and pay your tax, unfortunately. Plus, I think there is a certain extent to which I think, well, paying tax is not a bad thing, right? Because obviously people try not to pay too much tax, and there are legal ways not to pay tax, such as a SIP, such as an ISA. But, you really shouldn't have two bites of the cherry. If you're wealthy enough to invest, then you should have some social conscience and think about, why do you pay tax, right? It is redistributive to some extent. And yeah, I think that's just fair. So no, I don't think there's an easy way to invest if you're not happy with the SIP and your ISA limit is hit already.
I think Prince London, he's super chatted.
Oh, did he?
Yeah, question.
Oh, thank you very much is it Prince London?
Mm-hmm.
Thank you very much for your super chat. I appreciate that. And if anyone else wants to super chat, you get pushed to the front of the queue in terms of the questions. But anyway, thank you for that. And yeah, so let me just scroll down a bit. And let's see what we've got. What's the difference? So Mina Sedom says, what's the difference between US government bonds and Treasury bonds? Also, minimal liquidity is low risk, high return. Why choosing minimum volatility over it? Okay, so the first part, difference between US government bonds and Treasury bonds, there isn't any, right? So US Treasuries are US government bonds. In the UK, we call UK government bonds gilts. In fact, every country has its own name. So, you've got in Germany, you have bunds, bobbles, and Schatz, depending on the maturity of the bond. In the US, you've got notes, bills, and bonds. So each of the different maturities has a different name as well, just to make it more confusing. But anyway, yeah, US Treasuries are US government bonds. It's the same thing. Minimal liquidity is low risk, high return. Not sure what you mean by that. You can go for low liquidity funds, which deliberately buy equity which has low liquidity. So, for example, Vanguard has a VLIQ fund which targets low liquidity equity because there's a premium which you're paid to buy small caps and other low liquidity equities. I'm not sure that's what you meant. I could have gone for VLIQ. I just wanted a fund which, through this period, which I thought would be very volatile, and it has been, I'd rather have something which is low risk and boring equity, which is extremely well diversified. So another way of thinking about minimum volatility is maximum diversification. Mathematically, those two are actually equivalent. So that's why I like to be maximally diversified in this kind of environment. You take less risk that way. Okay, how are we doing? We've got 7 minutes.
Matthew just gave you £1. Listen.
Oh, Matthew, thank you very much. That's very kind of you. I appreciate it. So let's move on. And Johnny OC says, my SIP had a great week with the silver ETF, Wisdom Tree. Yes, silver's certainly shot up. You're absolutely right. So congratulations, Johnny. Well done. Zishan Rahman says, what's the difference between nicey, S&P 500 and Dow Jones? Why does Dow is called industrial average? Does it only have industrial stocks in it? Well, the Dow is an awful index. It's terrible. You shouldn't even look at it because it's price weighted. That's really archaic. Nowadays we always use market cap weighted indices, which means that the constituents are weighted according to the size of the company's outstanding shares in dollar terms, in currency terms. Whereas the Dow is price weighted, which is quite archaic for starters. Plus it has a fairly weird sector composition, so it's much better to have something like the S&P 500, which is market cap weighted, and it captures about 80 or 85% of US equity market cap. So it captures a much larger proportion of the US equity market. But the Dow is fairly weird. I never even look at it, to be honest. And serious people, serious investors usually don't look at the Dow. Financial journalists just seem to be stuck on it. I've no idea why. But nicey, there's a New York Stock Exchange, so it's an exchange where equities are traded, also options and other derivatives. So a stock exchange is different from an index, which is a weighted average of the stocks that trade on an exchange. So that's the difference between the two. But it used to be an industrial average because it used to be the Dow Jones used to be called an industrial average. It still is called that because it had a lot of industrial stocks in it. Okay, so yeah, I mean, I really wouldn't pay too much attention to the Dow. And Prince London, who paid us, thank you, Prince. You are a prince. Thank you for that. I'm holding in cash. Crash is coming in September or October. Oh, okay. I'll set my alarm. Excellent. Good to know. I mean, it's great that you're confident that you're fairly confident that it is going to happen. But, you know, I just can't time these things. You know, I wouldn't even try. All I know is that valuation is crazy high and the economics has never been worse in living memory. So for me, that's a fairly compelling reason to be cautious. But in terms of the timing, I mean, I really don't know. So Johnny says $30 silver coming soon. Great. Okay. Cool Dude 1995 says, hi, I'm 27. Great. And I'm invested in Vanguard, FTSE Global All Cap. Is there anything else I can invest money in or hold cash at the moment? Well, yes, that's a very broad question. I mean, you know, you could invest in anything. The choice is huge, but cash at the moment, I mean, it's funnily enough, I've spoken to several people recently who have very large cash positions, either due to selling a business or an inheritance or selling of property, and they're keeping it in cash, which isn't necessarily a bad thing. But over the long term, it's an atrocious thing, because with cash, it's hardly ever outperformed even bonds, right? So certainly for a very long period of time, holding cash is not good. In the current environment, maybe not such a bad thing. So, you know, if we do get deflation, cash would be great to hold because equity markets will be selling off. There'll be very large layoffs. There'll be corporate defaults, and cash would be great to hold. So, yeah, I wouldn't feel bad about holding the cash, but the important thing is to have an investment plan, right? So when things go back to normal, which they will, have a very clear idea of what proportion of equity and bonds you want to hold in your portfolio, and maybe even start drip feeding into that portfolio now, because you know you might miss the very bottom of the market, but at least you'll be investing for the long term. The really risky thing is that you hold back your money in cash and the market never sells off, right? So you're never fully invested and you hugely underperform because cash generally does that. So yeah, I'd be really careful about doing that for a long period of time, but not for short periods of time. Is there anything else you can invest in? Yes. But I obviously can't go through that right now, all the options. So how are we doing for time? We've got 2 minutes. Yeah. Mm-hmm. So let's have.
Prince is giving you more money.
Oh, Prince, thank you very much. That's very kind of you. Cash is trash. That's certainly true long term. Yeah. Whereas Prince says hold cash. Okay. Right. Okay. More about platforms going bust. You can always spread your money across 2 platforms. Yes, you can. But as I said, you know, I think that's fairly low on my list of risks. So for me, the inconvenience of having to have 2 systems and worry about 2 platforms is kind of not worth it. But for some people, if you are worried about your platform going down, yeah, you can certainly split it. But I don't think that's a huge risk in the UK at least. Okay. Yeah, equities are expensive if you think in terms of cash relative to gold and silver. They are a bargain. Yeah, I mean, yeah, I think if you think about the discounted cash flows of equity, whether you express that in terms of gold payments or cash payments, the point is that you know you pay a certain amount today for the future cash flows, and today you're paying much more than you do normally for the future cash flows that you're going to get. So my question would be why? Is there going to be a huge pickup in earnings that would justify it? But I don't see that pickup in earnings anytime soon. So, that's why I'm still cautious. But, if you look at pricing things in gold, the difficulty is you can't price gold itself, whereas you can price equity relative to risk-free assets like treasuries. So that's why I like equities, because you can price them relative to treasuries, whereas gold you can't. So I'd question any kind of valuation of equity relative to gold. One more question, and another trigger obviously for the sell-off could be a shock in US elections. That's certainly true in November. That's a concern for many people. Either way, if Trump stays in power, there's always the risk. Oh, another live chat. Thank you for that. Who is that?
It's Prince Alexandros.
Oh, thank you very much for that. Thank you, Prince. And who is that? Alexandros. Thank you very much for your for that super chat. I think the US elections is a bit of a wild card. I think certainly looking at the Trump tweets, it looks like he is discrediting the mail-in vote. So there's always the risk that he refuses to leave power, even if he loses the election. That's certainly the way he's building up to it. So that obviously would be a huge negative for equity markets if it looked like, a sitting US president wouldn't honor an election. I can't think there's been a precedent for that, but it certainly wouldn't be taken well by markets. And if we have a Biden presidency, some people have been saying that would be worrying for equity too, because there's always the prospect that he'll raise corporate taxes in order to pay off some of this debt. So, either way, I think that could be a trigger for an equity sell-off in November. But, we'll have to wait and see. But as I say, I'm still very cautious. And another live chat. Thank you very much. Talbot Sunbeamer. I appreciate it. Thank you very much. And remember, so let me just wrap up now because it's been an hour. If you look in the description, you can see what we offer. We have power hours with me, 1-to-1 like this, but it's just you and me. And you can find how to do that in the description below. We also have a free weekly market roundup where you can get my thoughts about what's going on in the economy and with markets, and I try to keep that interesting. And we also have the membership for $10 a month, where you can dial in to our weekly call, actually bi-weekly call, and you can also join us on the chat application Slack, and you can ask questions of me or other members of the community. So please do join us. Thank you for joining us this evening. It's always nice to have you on the call. We've had 438 concurrent viewers. That's great. 273 likes. Maybe we could still get a few more likes in the last 10 seconds. But please do like this, and also sign up for our channel, and then you can see our future content. So thank you all for dialing in on a Sunday evening. I appreciate it, and hope to see you as part of the community soon, if you're not already. Thank you, and good night.